If you're a UK landlord, you need to hear this. A perfect storm of tax and compliance changes is heading our way, set to hit in 2026, and it's going to completely reshape the rental market. And if you thought Section 24 was a nightmare, well, you haven't seen anything yet.
What we're about to go through is a special analysis put together by the tax experts at Pro Tax Accountant. These are the folks on the front lines helping landlords just like you get ready for what's coming, so let's just dive right in.
We're not just talking about another minor tweak to the rules here. This is a full-blown, perfect storm. We're talking tax hikes, crushing new administrative burdens, and a legal minefield that totally changes the game between you and your tenants.
And this isn't some guess about the future. The pressure is already immense. Get this, the government's own data from the English Private Landlord Survey reveals a staggering fact. Half, 50%, of all large-scale landlords are already making plans to shrink their portfolios or sell up completely. The exodus isn't coming, it's already started.
So here's our game plan for today. First, we'll do a quick recap on the shock of Section 24. Then, we're going deep on the 2026 double whammy of changes. We'll look at what that means for the market and, most importantly, we'll give you a real, concrete action plan to help you navigate it all.
All right, let's start with the seismic shock that really set the stage for all of this, Section 24. This was the first major wave to hit landlords, and believe me, the aftershocks are still being felt today.
So what is Section 24? Well, to put it simply, it completely rewrote the rulebook on mortgage interest. Before, you could deduct all of your mortgage interest costs from your rental income, which, lowered your taxable profit. Now, you pay tax on your gross rental income, and you only get a flat 20% tax credit back. It was a total game changer.
Now that might sound a bit like accountant speak, but its impact on your bottom line is very, very real, especially if you're a higher rate taxpayer. Let's look at a side-by-side comparison to make this crystal clear.
Okay, now what's really fascinating here is the chain reaction. Look on the left. Before Section 24, with £30,000 in rent and $15,000 in mortgage interest, your taxable profit was $12,000. Now, look to the right. Because you can't deduct that interest anymore, your taxable profit balloons to £27,000. Even after the credit, the final tax bill on that rental profit jumps from £2,400 to $3,000. That's a 25% tax increase, even though not a single extra penny of cash has actually hit your bank account.
And this is the real trap of Section 24. It artificially inflates your income on paper, which can easily shove you from being a basic rate taxpayer right into the 40% higher rate bracket. It's basically a hidden tax hike triggered by your own mortgage. But the storm didn't stop there. Oh no, it's now gathering strength and it's expanding its reach. The next target? The once safe world of furnished holiday lets. That's right. As of April 2025, the government has completely abolished the entire furnished holiday lettings, or FHL, regime. This basically yanks these properties out of their protected status and throws them into the same harsh tax world as standard long-term rentals.
And this was a huge blow. Holiday let owners instantly lost their ability to deduct full mortgage interest. Bam! Now they're subject to Section 24. They lost capital allowances. That's the tax break for buying furniture. They lost the amazing 10% capital gains tax rate when they sell, which now faces the standard 24%, and they even lost certain pension relief benefits. That tax shelter is officially gone.
So, all of this, it brings us right to the eye of the storm. If Section 24 was the first wave, then 2026 is the main event, a double whammy of administrative and legal nightmares, all converging at the same time. Think of this storm as advancing on two fronts. On one side, you've got Making Tax Digital, which is a complete top-to-bottom overhaul of how you report your taxes. And on the other, you have the Renters' Rights Act, which is creating a legal and financial minefield. Let's break each of these down.
First up, Making Tax Digital, or MTD. In a nutshell, this is the death of the annual tax return that we're all so used to. Starting in April 2026, it's being replaced by a system of mandatory digital record-keeping and quarterly submissions to HMRC. Yep, your yearly paperwork headache is about to become a constant year-round chore.
And here's when it hits you. The rollout kicks off in April 2026 for any landlord with a gross income over £50,000. And pay close attention to those two words, gross income, not profit. This is your total rent before any expenses are taken off, which means it's going to catch way more landlords than you think. A year later, it drops to $30,000, and by 2028, it's $20,000.
So what does this actually mean for you day to day? Well, you have to keep all your records digitally, no more shoeboxes full of receipts. You have to use specific HMRC-compatible software. You've got to send summaries of your income and expenses to HMRC 4 times a year. And on top of all that, you still have to file a final declaration. It's a massive increase in admin.
But honestly, the paperwork is only half the battle. And you'll really want to stay with me here, because the second part of this 2026 whammy, the legal changes, could have even more severe financial consequences.
On May 1st, 2026, the Renters' Rights Act is expected to come into force, and the single biggest change is the complete abolition of Section 21, the so-called no-fault eviction. Your ability to reclaim your property at the end of a tenancy without giving a specific court-approved reason. It'll be gone, forever.
And the government is backing this new act with some serious financial penalties. For repeated or really serious offenses, councils will have the power to hit you with fines of up to a staggering £40,000. This is not a number to take lightly. So what kind of simple mistakes could trigger these massive fines? Well, let's say you forget to give a tenant the correct new information sheet. That's a breach. Or you try to end a tenancy with a simple text message. That's a breach. If you use an eviction reason you can't prove in court, or you relet a property too soon after evicting someone to sell it, all of those are potential triggers for huge fines.
So when you combine these tax pressures, the administrative nightmare, and these huge legal risks, what's the inevitable result? Well, we're already seeing the aftermath. A landlord exodus from the sector, which in turn is causing rents to soar for tenants.
And this isn't some problem for the future. It is happening right now. Just look at the data. Rents were up a brutal 8% in 2023. That got even worse in 2024, climbing by 9%. And while it might have slowed a little in 2025, it's still at 6%. That's way above typical wage growth. This is the direct result of supply shrinking while demand stays high.
And industry experts see the direct link. Sean Hookers from the Property Redress Scheme says it perfectly. The sector is under strain. When we lose landlords, the supply of homes goes down, and that directly pushes rents up.
And let me be absolutely clear here. This is not a prediction. It's a documented trend, confirmed by the government's own surveys, which say that landlords are actively leaving the sector, specifically because of these tax and legislative changes.
Okay, so the storm is real and it is coming, but that does not mean you're powerless. Now let's pivot from the problems to the solutions. Here is a practical action plan for how you can prepare and weather this thing.
Here are 4 critical steps to consider right now. First, audit your costs. Go through every single expense with a fine-tooth comb. Second, review your financing and hunt for better mortgage rates. Third, explore your ownership structure. Operating as a limited company can shield you from Section 24, but it's not a silver bullet. It has higher costs and different rules. It's vital to assess if it's right for you. And fourth, streamline your portfolio. Think about selling any properties that are underperforming.
And here is a pro tip you can act on immediately. Go and set up a separate, dedicated bank account for all your rental income and expenses today. Keeping your property finances separate from your personal money is the single best thing you can do to prepare for making tax digital. Trust me, it will make the transition infinitely easier.
Look, the landscape we've just covered is undeniably complex. Trying to navigate this perfect storm of tax law, digital bureaucracy, and legal risk all by yourself is a dangerous idea, which is why getting expert guidance is just so crucial right now.
So let me ask you one final question. When you're facing potential 25% tax hikes, mandatory quarterly digital reporting, and the threat of £40,000 fines, can you really afford to go into 2026 unprepared?
Now, it is really important to remember that the information we've discussed here today is for general guidance. Your personal financial situation is completely unique.
And for that reason, before you make any big decisions, it is absolutely essential that you consult with a specialist who can analyze your specific circumstances. The tax experts at ProTax Accountant can give you that tailored advice, helping you with everything from Section 24 mitigation to MTD compliance and structuring your portfolio for the future. You can reach them on WhatsApp or by phone at 07985689912 or just drop them an email at info@protaxaccountant.co.uk. Don't wait for the storm to hit. Contact them today. Thanks for joining me.